Yeah, good morning, everybody. Thanks, Frank and Chris, for having me. So, as Chris mentions, I'm the CEO of a company called Exchange Corporation. So we've been operating in Japan since 2009. So we started the company in 2008. We have a, thank you. We have a money lending license. We have a Type 2 financial instruments license, and we have a vendor financing license. So we basically started in the fintech space in Japan before fintech was called fintech, with a service called Akshu, which is a peer-to-peer lender, similar to Lending Club or you may know Zopa in the UK. But like like the sort of typical venture path, we discovered that actually with all of the regulatory framework that we had for the peer-to-peer business, that actually we could go and create a really unique consumer experience with our payment product, Paidy. So I'll give an introduction of Paydy just to give some context to our sort of journey in the venture space. But I'll give you some numbers. We've raised a total of $11 million in VC. This is between seed, Series A, which came in 2 pieces, and actually we'll probably raise another fairly chunky round shortly. There's nothing to announce on that yet, but as Chris says, we are in the context of the discussion of this committee, we're sort of a recipient of venture capital. And we receive venture capital both domestically in Japan, so our investors are Recruit, Cyber Agent Ventures, some other different pure financial investors that are not corporate associated, and then also international funds. So we were one of the first investments in Japan out of 500 startups. We have money from Arbor Ventures, is a Asia-focused fintech specialist fund, and then obviously, as Chris mentions, we're privileged to have Susquehanna as one of our investors as well. So, what is Paidy? Paidy is or maybe I just do this. Sure. So, Paidy at its heart is a new payment method for e-commerce in Japan. What we've done is we've basically removed the need to have a credit card. We've turned your mobile phone into an instantly created credit account. So it's a post-pay credit account that's linked to your phone number. It's easy. You just check out with your phone number instead of checking out with your credit card number. Safe. Every transaction is verified with an SMS. Free. We don't charge anything to consumers. And no credit card is ever required. So what we do that is unique in this space is you may have seen other wallet products. There's Yahoo Fast Pay or Amazon ID Keisai, Rakuten ID Keisai. All of those are linking a credit card to a checkout, sort of line pay is the same. We don't do that, actually. We're instantiating a entirely new credit account to the consumer. So, as I said at the start, we're licensed in all various different ways as a financial services company. So one of the financial services that we provide is we will instantly create this credit account for consumers. And it's available to more than 100 million people in Japan. There's people that we have credit data on. Everybody here is able to use it. I encourage you to do so. Opportunity we're going after, as I say, I won't really make this a business pitch, but I do want to give some context to the types of businesses that actually can be venture-backed. As everyone will tell you, if you're not really attacking a big enough problem, then even if you solve winning a small market is not going to create the type of returns that are required for a venture-type investor. Our opportunity is Japan is a very unique market in a number of ways, right? Still very wealthy, a tremendous growth in terms of online purchasing, and most e-commerce transactions are on a smartphone, right? Japan and Korea have already passed to the point where really mobile commerce is e-commerce, right? It'll start to be this kind of, talking about mobile commerce will start to be superfluous in the way that you don't talk about color TV, right? Every TV is color. Eventually, the vast majority of commerce is going to be on a smartphone, not on a PC. But the funny thing is actually, even though many people in Japan have credit cards, they don't tend to use them online. So as I'm sure many of you know, in the United States, it's more than 90% of online transactions are paid for with a credit card. In Japan, it's only about 55. So 45% of the market is non-card settled. The big ones everybody knows, Daibiki, Konbini, Furikomi. So what we're doing is basically to all of those people that like Daibiki and Furikomi and Konbini Maibarai and Atobarai, it's basically because of the checkout experience on your mobile, right? Daibiki is just one-click checkout because they send it to you and then you pay. Payday is the same. We've created that customer experience of one-click checkout, but the difference is you don't have to pay the Takubin guy. You have a consolidated bill, you settle every month, you can get installment credit from us. So we've basically created the credit card experience from a settlement and an ongoing account basis, but we've given it the super simple checkout of a Daibiki or a Konbini payment. And this preference for non-card settlement methods creates some overhead for merchants. So I won't spend too much time on it, but it's a very subtle point. If you think about it, there's no such thing as a return for Daibiki, right? If I buy something and I pay for Daibiki, it's not like the Segawa guy comes, gives me cash, and then collects the goods, right? So this whole 45% of online transactions are paid for in a way that doesn't have a return mechanism, right? So there's all of this overhead that's associated with that we solve for merchants, where they can still address this same consumer base, but then have a flow on the back end that's exactly the same as a card. So Payday, cardless card, frictionless checkout. It's as easy as Daibiki. There's no card info, so people who worry about using their credit card online don't have to worry about it. And then we have the convenience of a consolidated bill and installment credit, exactly the same as a credit card. On the merchant side, the reason that they adopt Payday, we have a 20% increase in average order value. So basically this is a combination of higher conversions plus people being able to pay on installments so they can buy a little bit more. Payday's great at getting first-time customers. So we see roughly 30% are new customers for the brand. If you think about it, minimizing the friction for getting the first transaction is extremely helpful. And then because of the consolidated bill, actually same month repeat buying by Payday consumers at the same website is 60% higher than other payment methods. It makes sense. If you think about it, if you were historically a COD consumer, every time that you buy something by COD, you're committing to being home at a certain time in order to take delivery. Same story for convenience store payment. You're having to go to the convenience store. Because of the consolidated bill, buying once or buying 10 times is the same. You just have one monthly bill to settle to us. I'll go very quickly through this. The consumer flow is quite simple. You just choose Payday as the payment method. This is from the Dean and DeLuca website. You check out with your email address and phone number. That email address and phone number basically serves the same function as a credit card number in the credit card paradigm. We send an SMS. We understand that the phone is in your possession, right? Obviously, email address and phone number are not secret. This is part of the magic of Payday, right? I wouldn't be very comfortable doing a credit card transaction here on YouTube because it had my phone or my credit card number. But obviously, I can use Payday. It's not a big secret what my phone number is, right? We understand that it's really you doing the transaction by sending an SMS to the phone at the time of checkout. And then you can choose to settle it, just add it to your bill or enter into an installment at checkout. We approve in real time, and we guarantee to the merchant. So again, just like a credit card company, every Payday payment is 100% guaranteed. Right? We are then acting as the acquirer, and we settle to the merchant, and then we have an issuing relationship between us and the customer. But we facilitate real-time approval and instant shipment of goods, which again is very different than a cash on delivery or a convenience store prepayment or bank prepayment from the point of view of the merchant. I was going to do a demo, but I won't. But I encourage you to go and try Payday. It's very simple. It's a very interesting user experience. But I don't want to make this too much about the product. I do want to get into our experience. The other thing that's also extremely unique about Payday is there's no sign up. This again was very important. We as a company have taken it upon ourselves to use our own capabilities around data science and risk management in order to obviate the need for any pre-sign up, right? If you think about it, you don't sign up to do cash on delivery, you just do it. Payday's the same. So the first time you use Payday or the 1,000th time you use Payday, it's exactly the same. Email address and phone number. The only difference is from a legal standpoint or business logic standpoint, the first time you use Payday, that account is instantiated. and it's here. There's an account where after checkout you can go and see all of your purchases. It actually tends to be a little bit richer than a credit card account. So we actually have SKU level data. We see exactly what you bought, so you can see not just that you spent $300 at Adidas, but you can see what shoes, what size. And as I say, you can track transaction details. You see your payment history. You can change to installments. Obviously, from our business model standpoint, installments are a higher revenue sort of product. But even the single installment, obviously we collect some revenue for that. The consolidated bill is an entire month of shopping, and then you settle the next month on the 10th. So it's yoka getsu toka is when people pay us. Again, also very similar to a credit card. They get sent an SMS saying, okay, you've shopped all month. Here's your bill for last month. Please go and pay by the 10th. Settlement is primarily at convenience stores, but they can pay by furikomi, and we're adding Jido Furikai. So once we have the auto debit, then it's basically exactly a credit card, right? So we also use, there's Pay Easy, so people can settle to us at ATMs. But really what we're trying to do, the innovation in our company is really around account creation and checkout, not about settlement, right? There's a reason why every credit card in Japan is an auto debit from your bank account on the 10th. It just works. So Paidy basically is emulating that as well. We have a bunch of different brands that we work with. So we're now actually on more than 600,000 websites in Japan. We've been growing fairly rapidly. So you may not have encountered us yet, but hopefully you will at some point and have a try. Really, when you look at why there has been that merchant adoption, it's because we solve these four things, right? Reducing breakage. So COD, there's no guarantee that you're going to be home. So as a merchant, actually, if I do a daibiki transaction and the consumer isn't home, that's lost revenue, and there's lots of cost associated with that as well. Same story with convenience store payments. Up to 30% of the time, people just don't pay, right? And for, konbini maibara, right? As I mentioned, returns. So all daibiki, konbini, furikomi, there is no return mechanism. Basically, you have to have people in your finance department call the consumer, get their bank account number, and send the goods back to them. We get rid of that. We're basically exactly the same as a credit card. Because we have this deep and ongoing monthly relationship with all of our consumers, you can push a credit to their Payday account just the same as you can do a debit. So that helps a lot. And then I already touched on the new customer acquisition and AOV. And all of it really comes from the fact that we guarantee the payments 100%, right? We are basically serving as the intermediary between the merchant and the consumer, and we take that settlement risk and allow everything to flow. I won't get into exact numbers, but you can get some sense of our growth. So we do millions and millions of dollars every month. In general, we get about 12% checkout share across our network. There are some merchants where we get sort of 30, 40. It really depends on the demographics and the mix of devices. But in general, this is just to give some context to, for companies that are recipients of venture capital, really there's only one product of a startup company. It's fairly trite, but it's true, and that's growth. Right? It doesn't matter if you're doing Airbnb or you're doing transportation or it doesn't matter. Your obligation to your investors and your ability to have access to future capital, it's growth. Growth is what you produce. So we're lucky in that we've started to get traction in our market, and we're figuring out how to have this sustainable growth machine as we go and expand to more and more websites. Our business model is very straightforward. We charge merchants a flat fee of 3.5% of their transaction volume, so it's fairly in line with credit cards. If you look at all of the savings that we give them in terms of refunds and other guaranteed payments, actually in general we can usually make a fairly convincing business case that transitioning, a consumer that transitions from a non-card payment method like COD or convenience store to Payday basically is revenue enhancing. As I mentioned, we also have this second revenue line, which is we charge a 15% APR on the installment business that we do. As Chris mentioned, we've had various different businesses in Japan in the credit space, so we understand credit risk fairly well. So we sort of we have an important credit aspect to what we do, but this is also very helpful for our customers and for our merchants because instant installment credit obviously means that they can make bigger purchases on websites. And then, as I say, settlement merchants, we settled on the 20th of every month. Consumers settle to us on the 10th. So a consumer can shop all month, pay 10th of the next month. A merchant can sell all month and then get paid on the 20th of the next month. Very key part of what we do is actually, there's other buzzwords. We don't just have fintech, but we have, big data and machine learning and all of these other things that were sort of fashionable in the last 18 months or so. Where we have a very focused and dedicated machine learning effort, and what we're doing is just answering one simple question: is this person going to pay or not? Right? Every single transaction that comes through, we get an interesting data payload from the merchants. We know, what the consumer is buying, what their history with the merchant has been. We obviously look at the actual items they're buying. Then we also go and check third party, right? So we when was this phone number registered, the shipping address, how much is this going to Moto Azabu? Okay, maybe that has a different risk based on the property value in Moto Azabu than if it's going to, who knows, I don't know, Susukino in Sapporo. Maybe it's sort of different, right? And then we also work with some third-party services. So obviously, credit card fraud is a fairly well understood and big problem, so we don't have to reinvent the wheel. There's all sorts of other different services that you can interact with. And then on the credit side of our business, actually we have more than 100 million credit records, right? So the fascinating thing again about Japan, penetration of credit data in Japan is higher than in the US, right? Everybody thinks about the United States as very FICO score driven, very credit intensive society. But actually in Japan, we have more than 100 million records for 125 million people. US is only 200 million active files for 330 million people. And basically it's a difference between, having a population that's older and all documented versus younger and people who may or may not be part of this sort of official infrastructure. So very, very briefly, obviously a big part of what we're doing in our business is just getting better and better at understanding that credit risk. Sort of one of the assets of the company is the more transactions we have, the more not only active consumers, of which we have hundreds of thousands, but that we have hundreds and hundreds of thousands of transactions to go and basically understand what a good transaction, what a good consumer looks like. So that's Paidy. I mean, it's basically it's a cardless credit card. Primarily, our sort of core consumer base is a younger female, online shopper in Japan. We have lots of fashion brands. That sort of makes sense. So that's the business that we have now. That's really the business that's allowed us to raise the bulk of the money that we've raised, and really. When we look at what is going to drive the future of our company, that's really it. I guess I'll transition now to our story in fundraising in Japan. I don't know, Chris, do you want to? Yeah. Okay, sure. So on our side, as Chris mentioned, I left Goldman Sachs in early 2008, and the company was basically self-funded at the beginning. So unlike sort of the typical startup where you can be just a couple guys with an idea and you can invest a few $1,000s in servers, because we're a fintech company, right? And the finance side of that, I think everybody gets excited about the tech in fintech, but there's also the fin, right? So we had to basically start with, it was a little bit less than $1 million, but it was sort of chunky enough that you couldn't go out and get licensed, and also conform. You needed to obviously have enough shihonkin, right, to get the license. And additionally, there's this different overhead in finance in terms of you need to have compliance officers, you need to have all of this stuff from the start. So we started with what is probably a fairly chunky seed round or sort of founder commitment to get the business started. Then about a year later, we did a friends and family round. Again, that was maybe 60 or 70 million yen. And then after that, we then got access to the sort of international angel funds, right? So we were the second investment in Japan for 500 startups. This is before they had their Japanese vehicle. I guess it must be 2009 or 2010, something like that. And then, you know, we sort of went from founders to individual angels, then to angel funds, and then actually we sort of, again, as we made progress in some of the business lines that we had, got into corporate venture capital. So we raised some money from Cyber Agent Ventures. That was actually quite a good experience. Obviously, they remain a shareholder. We had a little desk at their startup base camp when it was over in Ayami Chome. Although already our team was sort of bigger, but it was sort of nice to be part of that community. And then after we sort of understood Paidy and really made the transition into Paidy, you know, we had access, as I say, to Arbor Ventures, which has been a great investor for us. So it's a specialist. I think it's I don't know if I'm allowed to say publicly how big it is, but anyway, it's more than $100 million specialist focused fund in Asia on just fintech. They were very early in the fintech space. So that was great. And you know, in general, I think you know, there are some specific challenges to being in Japan for sure. I think for us as a company, we've tried to go back and forth between the international money, you know, like there's cycles in every market, right? And I think that there does tend to be this lag. So for example, I would say right now, fintech is still super hot in Japan. I think it's actually cooled off in the valley a little bit more, right? So maybe in you know 2 or 3 months or 3 to 6 months or whatever, it may be a different environment here if there's this sort of this lag between the one to the other. Yeah, I mean, I think we, you know, in general, I think everybody wants to think that it's difficult to do things in Japan. And by and large, there are aspects that are tricky. I mean, I think, you know, but I think that actually as a business person, that's also advantageous. So for example, you know, I do think that there doesn't tend to be as much sort of real Series A capital in Japan. I think there are lots of people at the sort of seed or sort of you know, there's lots of corporate venture capital. Obviously, most of the, I mean, you know, the carrier affiliated or you know, like Cyber Agent Ventures, all these guys, right? Credit Saison has now set up their own specialist fund, but they tend to not be sort of Series A size, right? There's not sort of $3 to $5 million checks. It's really more like sort of seed or senior seed, right? Sort of, which I think is great. I think that gets a lot of companies started and a lot of different ideas, but there is this kind of valley where there isn't very much. And then I think for later stage, like, you know, Series C, D, E, like real growth stuff where you have the trading company. I'm sure there are some people here, so forgive me if I'm telling you your own business, but you know, I think there are people who you know, if you want to go out and you know, get a $20 million check, $30 million check, I think there's lots of that. But there's sort of this dearth in the middle a little bit. So on our side, how we've navigated that is really this shift between international money and domestic money. And I think on our side, what we'll very likely do next is in that interplay that's actually also being maintained in our next funding. Which will be much more onshore in Japan because, again, we've sort of passed through this sort of the place where there tends to be a little bit less money domestically in Japan, and we're getting into sort of doing bigger raises and feeling like a slightly more mature opportunity. So I think that's been interesting for us. And I wouldn't say that that's necessarily bad. I mean, I think for me as an entrepreneur, one of the things that is quite attractive about Japan is I think that there's still a tremendous amount of opportunity, right, to go out and make new and unique services for, you know, 100 million people, right, round numbers. So it's not a small opportunity. And the difference is, I think, all of these business chances are not being pursued by 10, you know, really smart, well-funded teams like they would be in California, right? That, you know. So I think if you are, as a company, able to amass talent and go after these opportunities, it's actually not a bad place to do it at all. And I think the other thing that's amazing, although it's not venture capital related, one thing in my experience and our team's experience here in Japan that has been very gratifying is, again, unlike the Valley, I think you have much more loyalty and less turnover in terms of teams, right? I think that's true not just in the startup space, but in general, across most business practice in Japan. But in a startup in particular, I think that's quite an advantage. So I'm very happy to ask or answer any questions. I don't know if this is exactly what you want to hear, but that's been our experience. And I think in general, we have tried very hard to get the best of all worlds, right? I mean, there are the bulk of our money comes from people that you've never heard of, but we also have taken money from Recruit, from Cyber Agent, from some other different people, because you have heard of them. And even from a customer standpoint, there's this sort of anshinkan of seeing some kind of kabunushi that is bigger. So anyway, very happy to answer questions if you have any. Thank you.
Your business model is in a regulated business.
Yep.
Because you're a credit lender.
Correct.
A consumer lender. Can you tell us something about your experience with the regulator and how you introduced a venture capital business model to the Kanto Finance Bureau and the FSA, and what their reaction was, and something about that whole experience without, I don't want you to badmouth the FSA.
No, and they're amazing. So, no. Oh, no. I mean, look, no. I think all jokes aside, I think our experience has been, by and large, very positive. Again, I think this is different than the story that, as fintech has gotten more focused. Like I participated in a panel at Medi, and there's all these. So on our side, we're regulated by. We have 3 different licenses. So one is Medi, another 2 are basically under the KLBF, right, or FB. What I would say is this: is actually it took us a long time. Actually, it took us probably maybe 2 years, circa, to kind. But I don't really like now that that's done. I don't really mind that. I know that seems kind of a funny thing to say, but I know there's now an emphasis on, excuse me, on trying to expedite licensing. I think London has tried to sort of style itself as this fintech, whatever. Obviously, Boris Johnson was here to talk about everything that they're doing and what Tokyo can do. And but I think on my side, here's what I would say: is I don't begrudge the fact that these things kind of take time. I think that's okay. You just have to understand that you need to invest time to do that. I would much prefer that than having a proliferation of services, one that may be of dubious quality and then lead to some, general lack of trust in what's happening in regulated space. And then 2, in a selfish way, given that we've suffered that pain already, right? You don't want, I think regulation by and large, as long as the goalposts don't move, and it is not a disaster. And I think if you have a good enough business idea, it just is what it is. It's table stakes. You just have to. It's the reality in which you operate.
Other questions?
Thank you very much for the great presentation. So I worked at the Japanese credit card company, and so I have 2 questions.
Sure.
So one is this business model is very important regarding the instant underwriting process.
Hi.
But Japanese credit bureau is very poor.
Right.
So how do you underwrite of the consumer?
So on our side, we do a combination of both. So the difference is, And if you look globally, there are lots of services that are starting to do this. So basically the idea is that the credit card paradigm is only on your bureau file, right? I do a moshikomi, I send it away, they check at CIC, they do shinsa. I mean, as gaijin, you wait,
Yes.
nan kagetsu kan, right? It takes a long time when your name is Cummer to get a credit card in Japan. But the short answer is we try and take a unique approach, which is looking not only at the kojin shingo joho, right? Not only at the credit file, but at the transaction data. So we have models, like everything that we do on the machine learning side, this actually isn't touching the credit file, right? So the idea is, if you look, and I think this is why this is quite a modern way of doing it. There are countries and jurisdictions where, so if you think about Southeast Asia or elsewhere, really all of that infrastructure of the credit bureau and the traditional credit file actually doesn't exist. But people are buying online, right? So that you are creating this sort of, this data set associated with your behavior that's very likely predictive for whether or not you're a good or bad credit risk, right? I mean, the same, you can think about like Nigeria, right, has already starting to really develop COD, based e-commerce. But I would posit that you can actually go and do analysis on somebody's COD behavior and decide whether or not you would take the risk of them being a post-pay instead of a COD customer. So on our side, the short answer is, just to give some context for other people in the room who may not know. So the largest credit bureau in Japan is called CIC. CIC is actually not available 24 hours a day. It closes. It's fairly strange. It's like when everybody moves to Japan for the first time, they're surprised that ATMs at the banks close, right? It's all for the same reason. They want to do a nightly batch update, or there's some old school process that needs to happen, right? So the way that we deal with that, it's just that depending on what is available at the time of the checkout, we will leverage whatever we have at our disposal. But a core part of what we do is understanding that, okay, well, actually, we can do something. We try and sort of fill in the gaps, right, so that the consumer doesn't feel the difference in that behavior. But it means that maybe our approval rate would be different, right? So it's a great question, and the short answer is, we're always trying to have as good a consumer experience as we can, but we do that by balancing between how heavily we weight on transaction data and how heavily we weight on credit data. And obviously, if credit data is not available, then we're still going to try and manifest the right consumer experience. We just do it in the absence of that. Again, obviously conforming to all regulatory requirements and everything else, right?
And so one more question is from my colleague.
Yeah.
So he values your one more another service is Akshu, which is
yeah.
social lending
That's
service.
right, yeah.
But recently, your company look like pivot. So you spend
Yeah.
almost resource to this Payday.
Payday, yes.
So why do you switch this?
It's a great question. Yeah. So again, and this kind of gives some context to the idea of the venture journey, both from a product standpoint and funding standpoint. The difference for us is, so we have this other service, Akshu, right, which is like Lending Club in Japan. The difference is Akshu wasn't a different enough consumer experience to really allow you to cost effectively capture high quality borrowers at scale. And as I said at the beginning of the talk, if you're not actually, the product of a startup is growth, right? So, Kashikingyo in Japan is this kind of declining industry, right? Payments is high volume, high growth. So that's sort of why we did the pivot. And we also learned a lot. I mean, if you look at Paidy, Paydy leverages very much everything that we learned at Akshu, right? Not only licensing and infrastructure, but Shinsa, our own track record, just on collections, all of these things. And we also really understood the following. If you look at Lending Club, the success of Lending Club, 85% of the loans that are done on Lending Club are refinance of existing credit card debt. It's basically this omatome loan platform, even though you don't think about it that way. And the arb that they're going after is there's oldest credit card debt in the US that's at 29, and then they're going out and refinancing it at 22. That's great. Japan isn't like that, right? And the reason that the refinance is so important for them is because it takes a while. It takes a couple weeks for a lending club loan to be originated. Actually, it was the same. Not a couple weeks, but it took us 4 business days. So, Paidy is very different. Paidy is instant, is completely different consumer experience than any other payment method. Whereas Akshu was a little bit cheaper than going to the ATM and getting a traditional card loan, but that little bit of cheapness wasn't sufficient to make up for the fact that the card loan product was instant. So, it's a good question. We did pivot, but we pivoted for a good reason, which is that this is really kind of a blue ocean in a high volume, high growth space. We're doing something completely unique in terms of customer value that we're delivering, both to the consumers that enjoy their Paidy accounts and the merchants for whom we solve problems. And that wasn't really the case for anybody in the social lending space, right? SBI, Moneo, us. Slightly cheaper money that's slower is okay, but it's not a mass market product. Paidy really is.
Toshio Sudo from Samurai Capital Fund Management Company. Yeah, it appears to me that the uniqueness of your business is taking the credit risk, and which is
Correct.
different from most of other venture business. And I'm wondering, how do you convince your investors about the mechanism of taking the credit risk? Although you explained well about
Sure.
you have the great mechanism of
Sure.
searching the fraud case and the
Sure.
unintentional unpaid cases.
Sure.
Yes, it's convincing enough, but maybe investors may need a much detailed explanation on that. But it's a black box, I assume. So,
Well, we're fairly open with our investor. I mean, so the short answer is I think there's two aspects to that question. I think the first one is, I think investors take comfort from the fact that we're not trying to reinvent the wheel, right? We do leverage other third-party services that understand credit card fraud. So Paidy is not a credit card, but basically the type of activity, if it's an IP address or a phone number or something that we know from another service was associated with fraud in the credit card space, we can leverage that, right? Also, there's other different behavioral stuff, how quickly somebody clicks through a website, if it's a hacker using a bot, how fast do they fill in the form, all of that. So we try and leverage basically what is already a very big industry around credit card fraud and analytics. And then number two is, I think, again, investors give us credit for progress, right? You don't have to be perfect. This is venture business. So on our side, we've been able to demonstrate just continual progress in terms of getting better and better at not only growing top line, but basically, mitigating and controlling the risk that we take in order to go out and get that revenue. But that's the core. There are two cores in making this business work, right? One is you have to grow top line by getting more and more merchants because those merchants bring you more and more consumers. But then, as you point out, number two is if you're not controlling the risk and making sure that you only get high quality consumers, or at least you don't have an abundance of people that are lower quality or fail to pay, then it won't work. But I will say, Japan is a great place to do this, right? Because by and large, not only is everybody in the system in terms of, credit data and analytics, but by and large, people are basically wealthy and want to pay. I mean, it's not a society that has a tremendous amount of fraud, either driven by by poverty or by sort of criminal element. It's a very benign environment to be a credit risk taking enterprise.
Okay.
Circling back to fundraising,
Yeah.
I was wondering if there's a reason why you waited 2 years before you went to get institutional money.
Yeah, I mean, I think the short answer is, so there is a very typical, benchmark that you can use about when you should go and raise different rounds, right? So obviously the sort of founder's capital is you just getting started. It is what it is. Friends and family, by and large, the same. Seed, in general, like in the time of our progress, that sort of seed round, usually you needed to have a product. You needed to have a product with consumers, with some revenue. So on our side, that sort of 2-year gap was driven by waiting for licensing before we could actually go and show that we had a product. And that was that. And then obviously on the Series A side, it tends to be like, okay, you know, you have a product and now you show that you have some customer acquisition that works, et cetera, et cetera. On our side, it was really, our Series A was more sort of, in some sense, almost like seed again, because it was primarily around the pivot to Paidy. But to answer your question, you know, the burden of getting institutional money is different than the burden of going to some ex-colleague at Goldman and saying, hey, we're doing this thing, it's great, okay, great, right? So it was the requirement that you really need to have customers and a business that's really operating in order to get institutional money at the start.
I have one last question for you, which
Sure.
is, you know, I've been here 35 years, and my experience is anytime you have a hot young business in Japan, along comes some big institution, and they disintermediate you. And I'm wondering about the threats to your,
Right.
I mean, your venture capital, fast growth. Maybe you can say something about the exit. Maybe you could say something about being other competitors
Right.
entering the same space.
Sure. Yeah, I think, again, I mean, this kind of harkens back to your question about, do I want the regulator to go any faster? I think slow regulation's fine because people have to go out and get licensed to compete with us, right? Look, I think nobody enjoys, you never get to get no company ever gets 100% of whatever opportunity they're after, right? There will always be people who come out and figure that it makes sense. We're not so focused on that, to be very honest, right? We focus more on how can we serve our consumers, how can we, you know, make things better for merchants, all of that. But I suspect that, yes, I mean, there are either people who are already in the non-card space, but in a sort of unlicensed way, or other folks, you know, that if you were a big e-commerce operator, you could start to do this kind of functionality for yourself. But I think there needs to be this very big, like, the value of the consolidated bill of Payday is just like Visa, right? Like you want it to be everywhere, and then the fact that you can consolidate from all these other different places is very valuable. So if somebody as a standalone website operator started to offer this for themselves, unless they could roll out to other places, I think that the value of the consolidation is a little bit less. But on our side, you know, I think there will be people who try and come and do what we want to do, and we just have to build on the momentum and the early lead that we have. And then on the exit side, I mean, who knows? I mean, I think, you know, when you take venture money, you know, the adage is really true, right? The day you take venture capital is the day you've agreed to sell your company, right? So that's the whole point. There will have to be an exit at some point. I think IPO is great. I mean, that's what everybody should say, and that's what I do say. But you know, I think as long as you build something of value, there'll be all sorts of optionality that comes, but better to focus on the value creation than speculating too much about what options may be available later.
Okay, well, thank you all for coming today.
Thanks, guys. Cheers.